You're staring at your screen. Red numbers. Again, the position you entered 3 hours ago, the one that felt so right, so obvious, is now down 2,000. Your heart's hammering, your palms are sweating. And somewhere in the back of your mind, a voice is screaming, close it now. But another voice whispers, just wait. It'll come back. It always comes back. Which voice do you listen to? Here's the brutal truth. If you're like 95% of traders, you'll make the wrong choice. Not because you don't understand charts, not because you lack strategy, but because your brain, that 3-pound supercomputer that got your ancestors through ice ages, is actively sabotaging your trades. The difference between the 5% who survive and the 95% who fail? Elite traders have mastered something you can't see on any chart. Something that has nothing to do with technical analysis or market timing. They've mastered the gap. The 3-second window between feeling and emotion, the space between fear and panic selling, between greed and over-leveraging, between hope and holding a loser while it bleeds your account dry. That gap is trainable, measurable, completely within your control. You're going to learn why losing 60% of your trades can still make you rich, why successful traders look bored during both massive wins and crushing losses, and why everything you've been taught about staying positive is destroying your account. Welcome to Trading Psychology Stick. Quick disclaimer, I'm sharing principles, not predictions. Your decisions are yours. Chapter 1, The Poker Face Paradox. Your face is lying to you right now, not to me, to you, because you think the goal is to feel nothing, to become some emotionless robot who doesn't flinch when positions move against you. But here's what nobody tells you. Elite traders aren't calm. They feel everything. The fear when a position gaps down, the euphoria when a trade goes vertical, the gut-wrenching doubt 7 trades deep into a losing streak. The difference? They've mastered the gap between feeling and reacting. Watch professional poker player. Their heart rate spikes when they get pocket aces. Cortisol floods their system when they're bluffing with nothing. But their face? Flat, neutral. Not because they don't feel the emotions, but because they've trained the 3-second delay between stimulus and response. Your brain is wired for survival, not profit. When you see that position drop $2,000 in 90 seconds, your amygdala hijacks your prefrontal cortex. It's the same system that saved your ancestors from saber-toothed tigers. Threat detected. React now. Except the market isn't a tiger. That's not escape. That's execution. Marcus bought 200 shares at 85. Strong setup. Clear support. Within 90 seconds, algorithmic selling pushed the stock to 75. Position down 2,000. Marcus felt everything. The stomach drop. The cold flash. The overwhelming urge to click, sell market, and make the pain stop. But Marcus counted. 1 Mississippi, 2 Mississippi, 3 Mississippi. 3. That's all it takes for blood flow to shift from your amygdala back to your prefrontal cortex. From survival mode to decision mode. After 3 seconds, Marcus checked his rules. Stop loss threshold, 2,500. Current loss, 2,000. Rule triggered? No. He held. 30 minutes later, the stock rebounded to 92. His position closed for a 1,400 profit. You can't eliminate the voice, you shouldn't try, but you can train the delay. The 3-second pause that creates neurological space between what you feel and what you do. Elite traders have poker faces because they've built a buffer, a trained response that interrupts the panic circuit before it reaches their mouse hand. The emotion still fires. The circuit breaker just gives them time to ask, is this feeling information, or is it trying to get me killed by a tiger that doesn't exist? Chapter 2. The 5% Survivor's Secret. 95% of traders fail, not struggle, fail, blow up, quit, walk away convinced the game is rigged. Most of them are making the exact same mistake and they think it's a virtue. They're optimizing to be right. Listen carefully. Being right doesn't pay your bills. Being profitable does. Sarah tracked her results for 6 months. Win rate, 68%. 2 out of every 3 trades were winners. She felt smart, validated. She was also down 14,000. Her average winner made her 200. Her average loser cost her 1,100. She'd panic sell winners after an hour to lock in profits. But losing trades, she'd hold those for weeks, convinced they'd come back. The math is brutal. 68 wins at $200, 13,600. But 32 losses at 1,100 equals 35,200 gone. Net result down 21,600. With a 68% win rate, now compare that to David. Win rate, 42%. He won 4 trades out of 10, lost 6. David made 7,200. David made 7,200. His 4 winners averaged $3,000 each, total $12,000. His losers averaged $800 each, total $4,800. He failed 60% of the time and still walked away with $7,000. This is the secret that only 5% of traders ever internalize. The ratio of your wins to your losses matters infinitely more than how often you win. You don't need to be right. You need to be right. Bigger than you're wrong. Here's the rule that separates survivors from casualties. Never enter a trade unless your potential profit is at least 3 times your potential loss. 3 to 1 minimum. Non-negotiable. You risk 500, you better be targeting at least 1,500. You risk 1,000, your target needs to be 3,000 or you don't take the trade. This single rule will force you to be selective. It'll kill 70% of the trades you currently take. Good. Those trades were distractions pretending to be opportunities. Your brain is going to fight you. Because accepting a 31 reward-risk ratio means accepting that you'll lose more often. Your win rate might drop 2%, 35%, even 30%. That voice in your head will whisper, "See, you're wrong again. You're bad at this." That voice doesn't understand probability. It doesn't understand that casinos get rich losing thousands of individual hands. Your brain craves certainty. It wants to be right. The market doesn't care what your brain wants. Chapter 3. Probability thinking. Your brain is a certainty addict. It craves guarantees. Predictability. The warm comfort of knowing what happens next. This is why you have a morning routine. Why uncertainty feels like nails on a chalkboard inside your skull. And this addiction is killing your trading account. Because the market doesn't deal in certainties. It deals in probabilities. If I hand you a coin and ask you to call it, what are your odds? 50-50, heads or tails. Now flip it, it's heads. Flip again, heads again. Third flip, heads. What's your brain screaming right now? Tails is DU, it has to be tails next. Wrong. It's still 50-50. The coin has no memory. Each independent event with identical odds, but your brain can't accept this. It sees patterns where none exist. It creates certainty out of pure randomness. This is exactly what you're doing when you revenge trade after 3 losses. When you double your position size because this one's different. When you convince yourself that because you've been wrong 5 times, you must be right on the 6th. Professional traders think like casino owners, not gamblers. A casino doesn't need to win every hand of blackjack. They just need a 2% edge over 10,000 hands. They'll lose hundreds of times tonight. They don't care. Because probability, given enough iterations, always wins. Here's the question elite traders ask. If I took this exact setup 100 times, would I be profitable? Not, will this trade work? That's certainty thinking. That's your addict brain looking for a fix. The right question is, does this setup have a statistical edge over 100 repetitions? A trader finds a pattern. Breakouts above resistance high volume. He backtests it. Win rate 35%. Most people would reject this immediately. I'm losing twice as often as I'm winning? No thanks. But look at the reward risk, 4,001. Run the math over 100 trades, risking 200 each. 35 wins at 800 profit each, 28,000. 65 losses at 200 each, 13 net profit, 15,000. You just made 15 grand while being wrong 65 times. This is probability thinking. This is how the 5% operate while the 95% are still obsessing over individual outcomes. You're not trying to predict the next coin flip. You're building a system that, over thousands of flips, exploits a mathematical edge. But even if you understand this, your brain will sabotage you. Because knowing you should think probabilistically and actually executing trades with a 35% win rate, those are 2 very different things. Which is why you need the 20-trade evaluation window. Never judge your system based on fewer than 20 consecutive trades. You're not evaluating individual outcomes, aggregate performance. Daniel implements a new strategy. Backtested edge. Win rate, 45%. Reward risk, 2.51. Over 100 trades, the math says profitable. He takes his first trade. Loss, 400 gone. Second trade, loss. Third trade, loss. 7 trades in, Daniel is down 2,800. His brain is screaming, stop, this doesn't work. But Daniel committed to the 20-trade evaluation window. He keeps executing. Trades 8 through 20, 9 wins, 4 losses. Final tally after 20 trades, 9 wins at 1,200 average equals 10,800. 11 losses at 400 average equals 4,400. Net profit, 6,400. Those first 7 losses, statistical noise, variance. The same reason you can flip a coin and get 7 heads in a row. Those first 7 losses. Statistical, you can flip a coin and get 7 heads in a row. If Daniel had quit after trade 7, and most traders would have, he'd have missed the entire profit. You're not trying to win every trade, you're building a statistical edge that over enough repetitions grinds out consistent profit. Your edge doesn't show up in trade 3 or trade 7, trade 500, trade 1,000. Chapter 4, the discipline architecture. You think elite traders are disciplined. You're wrong. Elite traders are lazy, methodical, almost boring in their refusal to make real-time decisions. Because they've discovered something that changes everything, discipline isn't willpower, it's architecture. It's Tuesday at 2004, 7 p.m. The market just dumped 3% in 17 minutes on breaking news nobody saw coming. Your position is bleeding, CNBC is screaming. Every cell in your body is firing the same message, do something. This is the moment where discipline as willpower fails. Because willpower is a finite resource. It depletes, it cracks under pressure. Elite traders don't fight this battle. They won the war 2 days ago, on Sunday. When they were calm, here's the truth that changes everything. Your Sunday self is smarter than your Tuesday 3 p.m. during volatility self. Not a little smarter, exponentially smarter. Sunday, you has a fully functioning prefrontal cortex. Sunday, you can analyze probabilities, consider scenarios, build rules based on logic instead of fear. Sunday you is a strategist. Tuesday you is a survivor scrambling not to die. So why are you letting Tuesday you make decisions? Elite traders build systems during calm, then surrender to those systems during chaos. Every Sunday you create 15 to 20 rules, not guidelines, rules. Specific conditions paired with specific actions. If position reaches plus 10% within first hour, then take 30% profit and raise stop to break even. If position drops 3% on unusual volume within 30 minutes of entry, then exit immediately regardless of stop loss. If VIX spikes above 30, then reduce all position sizes by 50%. These aren't predictions, they're pre-decisions. You're building a decision tree that accounts for every scenario you can imagine, then committing to execute whatever branch gets triggered. David builds his playbook on Sunday. One rule: if any position reaches plus 10% within the first hour, take 30% profit and raise in Tuesday morning. He buys a stock out of 50. By 10:15 a.m., it's at 55, up 10%, exactly 63 minutes after entry. David doesn't think, doesn't evaluate. He pattern matches to his playbook. Rule triggered, action required, sell 30%, move stop to 50. He executes. At 2:30 p.m., surprise FDA announcement. The stock crashes to 51. David's remaining position exits at his 50 break-even stop. Total plus 150 from the 30% he sold early. Zero loss on the rest. If he'd ignored the playbook and held the full position, he'd be sitting at break-even with nothing to show for a trade that was up 500 at one point. The playbook didn't predict the FDA announcement. It didn't need to. It just protected profits during uncertainty. Here's what most traders do. They enter a position, then spend the next 3 hours making real-time decisions based on how they feel, what they're seeing, what their gut is telling them. That's not tradingization. And over 100 trades, improvisation gets destroyed by architecture every single time. Under pressure, you're measurably dumber. IQ drops, time horizon collapses, risk assessment breaks, stop deciding under stress, decide Sunday, execute Tuesday, robot mode, system over self. Every time. Chapter 5, The Present Moment Protocol. You bought the stock at 50. You had a plan, a thesis. You identified the target, 60, clean 20% move. You entered with confidence. Now it's 47, down 6%. And your brain is doing something lethal. It's writing fiction. It'll bounce back. This is just a pullback. Support is at 45, then we're good. Next earnings will crush it. None of this is on the chart. None of this is provable. You're projecting a future that exists only in your imagination, and you're treating it like data. This is how accounts die, not with a bang, with a story. The market doesn't care about your mortgage payment. It doesn't care that you need trade to work because the last 3 failed. It doesn't care about your dreams. The market is price and volume. Right now, this second. Everything else is narrative, fiction, projection. Here's what elite traders do instead. They run the present test. Every 60 minutes they ask one question, based only on what the chart shows right now, not what I hope or fear. Am I red or green? Red means exit. Green means hold. No stories, no projections. Red means exit. Green means hold, no stories, no projections. Marcus bought at 50, targeting 60. Current price 47. He's down 600 on a 200 share position. His brain wants to hold. It's only temporary. But Marcus runs the present test at 11 a.m. What does the chart show right now? Downtrend intact. Support at 48 broken. Reversal signals, none. Volume increasing on down moves. Verdict red. Exit. He sells at 47, locks in the 600 loss, feels sick about it. By close, the stock is at 42. That temporary pull brain invented never happened. The present test saved him from a 600 loss becoming a 1/600 loss. Your brain is a pattern recognition machine that evolved to predict tiger attacks and find berries. It's phenomenal at inventing narratives. It sees 3 data points and constructs an entire story arc. This is why you hold losers. Not because you're stupid or undisciplined, but because your brain is doing what it was designed to do, creating comforting stories about uncertain futures. The stock will recover is a story. I'll make it back next trade is a story. This always happens before the big move is a story. The chart doesn't tell stories. It shows you price, volume, trends, support, resistance, present tense, provable, real. Here's the second part of this protocol. Ignore your entry price. That number is now burned into your brain. It's your reference point, your anchor. Every price tick gets measured against it. And this is killing you, because the market doesn't know you bought at 80. It doesn't care. That number exists only in your head. What actually matters, what is the chart showing right now? Alex at 80. The stock is now at 75. He's down 500. Every 15 minutes he looks at the chart and thinks, I'm down 500, I need it to get back to 80. That's backward. The question isn't, how do I get back to 80? The question is, if I had no position right now, would I buy at 75? Here's the test. Alex runs every 15 minutes. 10,015 a.m. If I had no position, would I buy here at 75? Answer, yes. Support is holding at 74.50. Bullish candle forming. Decision, hold. 10,003 a.m. If I had no position, would I buy here at 75.20? Answer, yes. Price broke above 75 resistance. Decision, hold. 10,045 a.m. If I had no position, would I buy here at 74.24? Answer, no. Support at 74.50 just broke. Downtrend forming. Decision, exit immediately. Alex sells at 74.50. He's down 55. By 11,030 a.m., the stock is at 70. His refusal to anchor to his $80 entry saved him from a 550 loss, becoming a 1,000 loss. The $80 entry is history. It's gone. The only thing that matters is what the chart is telling you right now about where price is likely to go. Next, every 15 minutes you need to reset. Treat window as a fresh decision. Ignore your entry price. Ignore your P&L. Look at the chart like you're seeing it for the first time and ask, based purely on current price action, would I enter this trade right now? If the answer is yes, hold. If the answer is no, exit. Your entry price is an anchor dragging you into the past. The present moment protocol cuts that chain. Trade what is, not what might be. Chapter 6, the loss aversion trap. Your biology is trying to bankrupt you, not metaphorically, literally. Right now, there's a neurological system inside your skull that was optimized over millions of years to keep you alive, and it's systematically destroying your trading account. It's called loss aversion, and you feel it 2.5 times more intensely than you feel equivalent gains. A 1,000 loss hurts you more than twice as much as a 1,000 gain feels good, 2.5 times more. This isn't psychology. This is hardwired neurobiology. Your ancestors who avoided losses survived. The risk takers got eaten by predators or starved during harsh winters. Loss aversion kept humans alive. But you're not avoiding predators. You're trading stocks. And the same system that saved your great-great-grandfather from saber-toothed tigers is now making you hold a losing position for 3 months while it bleeds your account dry. You enter a trade. It immediately goes against you. Down 2%, down 3%. You know your stop loss is at 5%, but you don't want to take the loss, so you tell yourself, I'll give it more room. Down 7%. Now you're past your stop. But selling means admitting you were wrong. So you hold, it'll come back. Down 12%, the loss is too big to accept now, so you double down on hope. Maybe you even add to the position to average down. Down 18%. You're numb now. You stop checking the price because looking at it hurts too much. This is loss aversion in action, and it's killed more accounts than crashes, than fraud, than black swan events. Now compare that to how you handle winners. Up 3%? Better take profits before it reverses. Up 5 win is a win. Lock it in. Up 8%? I don't want to be greedy. Here's the problem. Both of those emotional responses are destroying your ability to trade, because the moment you label a situation as good or bad, you activate emotional circuits that override rational decision-making. Your brain shifts from analysis mode to reaction mode, from trader. Elite traders see something completely different when price moves. They don't see failure or success. They see a situation that requires response A or response B. That's it. No moral judgment. No narrative. Just, does this trigger a rule or doesn't it? Victor buys a stock at 100. Clear thesis, defined stop loss at 82, target of 130. His reward risk is dialed in. Next morning, surprise FDA rejection. The stock gaps down to 85, then bleeds to 82 by 10 a.m. Victor's position is now down 18% in less than 24 hours. What does he feel? Everything. The gut drop. The cold sweat. But here's what he does. He runs the OOD loop. Observe position is down 18%. Current price, 82. Orient, my stop loss is at 82. Is this within expected system parameters? Yes. Volatile stocks hit stops. This is normal. Decide, does this trigger my exit rule? Price touched 82. Stop triggered. Act, execute the exit. Sell at 82. Story about how unfair the FDA is. No narrative about manipulation. Just rule triggered. Execute. Victor closes the position for an 18 loss per share. Feels nothing about it. Because to him, this isn't a bad trade. It's not a failure. It's data. The system worked. The stop protected him. The next setup is already forming. Here's the truth that'll set you free. A losing trade isn't a failure. It's data. A winning trade isn't validation. It's data. Both are emotionally equivalent inputs into your statistical edge machine. When that stock recovered 3 days later and rallied to 95, Victor felt nothing. No regret. No, I should have held. Because the decision wasn't about the outcome, it was about the rule. Situational neutrality isn't about upling emotions from execution. Feel everything. React to nothing. Now here's the second part. Even positive emotions are dangerous. You just closed a position for an 8,000 profit. Your phone is in your hand. You're texting friends, posting screenshots. The dopamine is flooding your system. You feel invincible. And in this moment, you're more dangerous to your own account than any losing streak. Because you think positivity fuels success. You think emotional highs drive performance. You're wrong. Positivity is sugar. It tastes incredible, gives you a rush. Then it crashes and you're left chasing the next hit. Elite traders don't operate on positivity. They operate on equilibrium, flat emotional lines. The same internal state whether they're up 10,000 or down 10,000. Marcus closes 3 winning trades in a row. 3,000, 4,500, 2,800. Total, 10,300 in 6 days. He's on fire. His confidence is soaring. So what does he do next? He increases his position size. Not because his system says to, but because he feels good, because he's in the zone. He enters the next trade with double his normal size. The trade fails to his typical 800 loss. He's down 600. Suddenly, the high evaporates. Now he's frustrated. He needs to make back that 1,600, so he revenge trades. Bigger size again. 3 days later, Marcus has turned a 10,300 winning streak into a 2,100 net profit. He gave back 8,200 because he let emotions, positive and negative, dictate position sizing. Here's what elite traders do instead, the flatline debrief. After closing any position win or loss, they write 3 factual observations. Not feelings, not judgments. Facts. Marcus closes that 8,000 winner. Instead of celebrating, he opens his journal. Entry signal appeared at 9:47 a.m. on breakout above 52 resistance. Target hit in 6 days as expected. Position size was appropriate at 4% of capital. That's it. No, I'm a genius. No emotion, just documentation. 3 days later, he takes an 800 loss. Same process. Signal appeared at 2:13 p.m. on hammer candle at support. Stop triggered at 2% account risk when support failed. Position size was appropriate at 4% of capital. Same tone, same format, same emotional temperature. Because to Marcus, both trades are identical. Data inputs, system outputs, neither validates nor invalidates his worth as a trader. This kills the dopamine addiction. It prevents the emotional roller coaster that causes overtrading after wins and paralysis after losses. Professional traders treat wins and losses like a surgeon treats successful and failed operations. Document, learn, move to the next patient. No celebration, no mourning, just work. Here's the goal. Someone should be able to watch you trade for 8 hours and have no idea whether you're up or down. Your face, your tone, your behavior identical throughout. Chapter 9, the winner, extension strategy. You're up 1,500 on a trade. You're up 1,500 on a trade. Your heart is racing. You can feel it. That intoxicating mix of validation and fear. Fear that it'll reverse. Fear that you'll watch these profits evaporate. So you close it. Lock in the gain. Walk away feeling smart and disciplined. Meanwhile, that stock you just sold runs another 3,500 over the next 2 weeks. You left 3,500 on the table because you were afraid of losing 500. This is the silent killer. The mistake that doesn't feel like a mistake, because taking profit feels responsible. But here's the truth. The real money in trading isn't made from collecting dozens of small wins. It's made from letting 2 or 3 massive winners per year run to levels that feel uncomfortable, irrational, even obscene. You enter a trade risking 500, targeting 500, 3-to-1 reward risk, clean setup. The trade works. You hit your 1,500 target and you sell. All of it. You just capped your upside at exactly the point where the real profit begins. That you sold at plus 1,000, 500, it runs to plus 5,000 over the next month, but you're not in it. 10 times, 35,000 left behind, 15,000 collected. Elite traders don't bail out. They scale out. Here's the framework, the 50-25 exit ladder. When your trade hits 2x your risk target, you sell 50%. Lock in profit. Take money off the table. When it hits 4x your risk target, you sell another 25%. Now you've banked 75% of the position and you're playing with house money. The final 25%, you let it run with a trailing stop. You give it permission to become stupid profitable. Because this is where generational trades live. You risk 500 per trade. Your target is $500. The trade works. At plus 500 profit, you sell 50% of your position. You pocket 750. Your risk is now eliminated. The stock keeps running. Hits plus 3,000 profit. You sell another 25%. Pocket another 750. Total banked 5,000. The stock runs to plus $5,000, 200 on the remaining 25%. You pocket another 1,050. Total profit $2,500. You just made $2,500 on a trade where you almost exited completely at 1,500. The extra 1,050 came from the discipline to let the final piece run. If you'd sold everything at 1,500 like your emotions demanded, you'd have made 1,500. Still good, right? Except you just left 1,050 on the table. And if you do this across 20 trades per year, that's 21,000 in missed profit. Your biggest winners will feel wrong. They'll feel like you're being greedy. They'll trigger every instinct to sell and lock it in. But the 5% who survive? They've trained themselves to feel that discomfort and hold anyway. Because they know the secret: small wins pay the bills. Big wins change your life. Chapter 10, The Repetition Mastery. You're bored. You've taken the same setup 3 times this week. Morning gap fill on high-volume tech stocks. It worked twice, failed once, and now you're sitting here at 9:45 a.m. watching the exact same pattern form again. And your brain is screaming, not this again. Find something new. You're missing other opportunities. So you skip it. You go hunting. You find a better setup, something fresh, exciting, different. You take the trade. It fails. And meanwhile, that boring gap fill you skipped, it runs for 8% in 90 minutes. This is how traders destroy edge. Not through lack of knowledge, through inability to tolerate tedium. Trading success is monumentally boring. It's repeating the same 3 setups thousands of times while your brain begs for novelty. Elite traders are comfortable with tedium because they understand something most people never grasp. Edge comes from specialization, not variety. Mastery is repetition. Jennifer identifies 3 setups that fit her schedule and personality. Morning gap fills on stocks with volume above 5 million. Afternoon reversals at key support levels. Earnings momentum plays on stocks gapping 10% plus. That's it. 3 setups for the entire year. On January 15th, she sees a perfect breakout pattern. Clean chart, great volume. But it's not one of her 3 setups, so she passes. February 3rd, another opportunity. A crypto stock going parabolic. Everyone's talking about it. Her friends are making money. Not one of her 3 setups. She passes. This happens 147 times over 12 months. Brain screams FOMO, leaving money on the table. But here's what happens. By month 12, Jennifer knows her 3 setups so intimately that execution becomes automatic. She can spot a morning gap fill in 3 seconds. She knows exactly what a real reversal looks like versus a fake out. Win rate, 64%. Average reward risk, 321. If she takes 200 trades over the year, 100,600 equals 24,800. 72 equals 36,000. Net, 168,800. All from 3 boring setups, repeated, over and over, while everyone else chased novelty and went broke. Here's the rule, the 3 setup maximum. Here's the rule. The 3 setup maximum. Identify 3 setups that match your personality, schedule, and risk tolerance. Trade only these for 12 months. Track every stat, odds, everything else. Your brain will rebel. It'll tell you you're missing out. That successful traders are flexible and adaptive. Ignore it. Because here's what your brain doesn't understand. A master sushi chef doesn't cook Italian, Mexican, and French cuisine. They make sushi, the same dishes, thousands of times, until they can do it blindfolded. You're not trying to be a generalist. You're trying to be a specialist so skilled at your 3 setups that you have an unfair advantage. Chapter 11, The 10,000 Trade Vision. You're thinking about tomorrow. Whether this trade will work, whether you'll make back last week's loss, whether you can hit your monthly target, and this short-term thinking is why you'll never make it. Because professionals are playing a different timeline. While you're obsessing over tomorrow's P&L, they're asking a completely different question. Will I still be trading in 2035? That's the game. Not tomorrow, not this month, not this year. Survival. Longevity. Being in business when everyone else has blown up and quit. A trader sees a setup. High risk, high reward. If it works, he could make 40% on his capital in one trade. The catch? He'd have to risk 15% of his account. But the potential payoff is worth it, right? 40% gain versus 15% risk. Except it does not thinking in trades, he's thinking in decades. Here's what elite traders do. The decade projection exercise. You take your current account, let's say 25,000, and you calculate compound growth at a modest 2% monthly return. Not hero trades. Just consistent boring 2% per month. That's 24% annually after compounding. Where are you in 10 years? 25,000 becomes 218,038.6. That's the power of staying in the game. Of not blowing up. Of treating trading like a statistical edge machine that compounds micro advantages over 120 months. Now let's run the other scenario. You take that 15% risk trade. It fails. You take another. It fails. 4 big risk trades go wrong over the course of a year. 4 15% losses equals 60% drawdown. Your 25,000 account is now 10,000. You just set yourself back 3 years of 2% monthly compounding. 3 years. Because you wanted to be a hero in one trade instead of a professional over 10,000 trades. This is the shift that changes everything. You're not building a strategy. You're building a 30-year statistical edge machine. Every trade you take either moves you toward that 2035 vision or away from it. So when that high-risk setup appears, you don't ask, will this work? You ask, does this trade protect my ability to be here in 2035? If the answer is no, if one bad outcome could cripple your account, you pass every time. No exceptions, no FOMO. Because here's the truth, you don't need big wins. You need to not blow up. The traders who make it aren't the ones who hit massive home runs. They're the ones who are still standing after everyone else tapped out. If you can average just 2% monthly, nothing spectacular, no heroics required, you turn 25,000 into 218,000 in 10 years, into $1.9 million in 20 years, into $116.6 million in 30 years. But only if you survive, only if you're still in the game. Every reckless trade, every ego-driven revenge position, every over-leveraged gamble is a bet against your 2035 self, against the compounding machine, against the long game. A leader thinking in 10. That's why they're still here and you're wondering if this whole trading thing is even possible. The question isn't whether you can make money tomorrow. It's whether you can protect your capital long enough for probability to do what it always does. Reward the patient. Destroy the reckless. You, to make it? Stop thinking about the trade. Start thinking about the trader you'll be in 2035. That's the game. That's always been the game. And now you know how to play it. So here we are. You now know the truth. Trading isn't a technical problem. It's a psychological game. And the moment you stop fighting the market and start managing your own mind, everything changes. But knowledge without action is just entertainment. Here's what I want you to do right now. Not later, not when you have time, but right now. Open a document. Write down your 3 setups. Not 10, not whatever looks good. 3, the patterns you'll trade for the next 12 months. Nothing else exists. Then write your if, then playbook. 15 rules minimum. If position hits plus 10% in first hour, then if thesis breaks within 6 hours, then build the architecture now while your prefrontal cortex is working so you don't have to think when the chaos hits. Then write your if, then playbook. 15 rules minimum. If position hits plus 10% in first hour, then if thesis breaks within 6 hours, then build the architecture now while your prefrontal cortex is working so you don't have to think when the chaos hits. Finally, run the decade projection. Calculate where you'll be in 10 years at 2% monthly returns. Write that number down. Put it somewhere you'll see it every single day. Because that number, that's your real target, not tomorrow's trade. That decade number. Do these 3 things before the market opens tomorrow or you'll forget. You'll get distracted. You'll convince yourself you'll do it later. And 6 months from now, you'll be in the exact same place wondering why nothing's changed. Now here's the part that separates people who think about change from people who actually change. Take one of those 3 things you just did and make it public. Post your 3 setups in the comments below. DM me your decade number. Text your playbook to a trading partner. But if it stays private, it stays theoretical. Make it real. The ones who make it aren't smarter. They're not more talented. They don't have secret strategies. They just did the work. They built the systems. They commit it was boring and uncomfortable and felt like it wasn't working. You can be one of them. But only if you start right now, not tomorrow. Now. The 3-second circuit breaker, the 31 reward risk minimum, the Sunday blueprint, the 20 trade evaluation window, the 2% hard stop, the present moment protocol, the 6-hour rule, the emotional equilibrium code, the 50s 25-25 exit ladder, the 30 setup maximum, the decade projection. These aren't theory, they're tools. Use them, because the market doesn't care about your potential, it cares about your execution, and your execution starts the moment you close this video. What are you going to do?